welcome everybody. We're gonna hang out for a minute while everybody's getting settled. I'm gonna post an agenda in the chat and we'll kick things off shortly. Let's see. And here's the sample we're gonna go through today. Oh, and that didn't link the actual sample return, so let's try this again. Beautiful. Cool. Uh, Good to meet everybody. So today's session is intended to be like a follow-along session, which is a little different from what we normally do. My goal is to go through every step of how to do an analysis in Holistiplan. So I'm going to kick things off by starting the free trial period, going to our website and signing up for a trial. We're going to go through a sample tax return that I have here linked. You don't have to use my sample today. If you want to upload a different tax return, that's totally fine. But I'm going to be showing every step for this sample, how to generate the reports and like how to actually analyze what we see in those reports. Also, a side note, some people here may have already seen a demo or videos and whatnot. Those sessions usually are a little bit faster. We'll probably go a little bit slow today, again, because we're going to do every single step. And that's intentional. If you have questions, post them in the chat. And I'm going to start sharing my screen. We can start going through this analysis. So let's see here. If you don't already have an account or don't already have a trial period for Holistiplan, if you go to our website, start a free trial, and then I'm going to fill out this form so that you guys can see what it looks like. Side note, some firms do have like their own version of Holistiplan. So if you're affiliated with a large broker-dealer or a large RIA, you can you need to use like a specific sign-up link for that broker-dealer or RIA. We can change the affiliation later. So if you just sign up for this general start page, just know that we can put you on the right version later. But if you already have the link, just use the link that you're supposed to use. So I'm going to go ahead and create my account. Enter my email. And password. Do note that the password requirements are kind of strict, and you do have to retype your password. Copy pasting won't work. Follow along. I referred myself. And then when you sign up for a free trial, we've got annual, monthly. Those are billing options. It's always a 12-month term. And I'm going to go through the premium features today. So I am signing up for the premium plan. When I go through features, any of our purple features will be premium features today. And then I'm not going to cover the insurance analysis today. So I'm going to go ahead and skip that part for now. And I am going to pause my screen sharing momentarily while I enter my card details. Let's see. 8. Beautiful. All right, I got mine entered and start free trial. Awesome. So I'll talk for a little bit real quick while people might be getting to this step. But when you first get access to Holistiplan, we have a lot of great welcome resources and whatnot. I'm not going to go through some of that training stuff today. We're going to go ahead and go straight to the household section. And then when you get to that household section, we actually will have a sample return that's preloaded already. I'm not going to use that sample. I'm actually going to use a different sample, which is why I put it in the chat. But we're going to use Robert and Roxanne from our samples in that linked knowledge base article. So I'm going to go ahead and add a household. And we will need to download their return, but I'm going to upload, or I'm going to add their client information first. So you click add household, and I have Robert, retiree, and add client to make sure I add in Roxanne, retiree. I'm going to say they're both in California because that's where I'm at. And for birth dates, Robert is 1/12/1952, and Roxanne is 06/20/1954. So that's the minimum information I need to enter. I'm going to go ahead and add that household. And now I'm going to get their tax return from our samples that we have. So I have this sample linked in the chat. Let's see. So I'm going to our knowledge base, and we've got some sample returns. So if you go to the knowledge base, it's under the sample returns here, and specifically we're using this Robert and Roxanne retiree sample. So I'm going to go ahead and just download that. And I already have this saved. We're just going to save it again. And now that I have that downloaded, going back to my households section here, and this account I just created, it doesn't matter where we upload from. There are several places that we could do it, but I'm going to go ahead and upload right here for 2025 for that new household that I just created. So let's see, we've got Robert and Roxanne retiree. Upload. Cool. So the first parts of this were the most difficult so far. This part is the magic part. We do the optical character recognition. So it reads that whole tax return that I just uploaded. And then once it's done, which this one just finished, now I have some automatic summary reports that we can analyze. And we'll go through what happened in that tax return, what some of the opportunities are, and we'll start to do some analysis and projections. So I'm going to go ahead and click on Robert and Roxanne retiree. Side note, if you're not following along with this sample, just know that sometimes it can take longer to do the analysis. So if you got your tax return flagged to this middle bucket, that means it's going to manual review. Our team's going to look at those and type in the numbers for you for that tax return, and it could take about an hour. So if you can catch up to us, great with the sample, awesome. But this one passed, it should pass every time. So I clicked on Robert and Roxanne's name. I can see Robert is 74, Roxanne is 71, and she has her first RMD next year. For our analysis today, we're going to assume that she's going to have a significant RMD in 2027. So we're going to say she has about 2 million in pre-tax money, and that's going to be a big part of this analysis. If I go to the tax returns section, we've got our original document, we've got the automatic summary tax report, and then we've got the tax explainer and scenario analysis. Tax explainer is probably the simplest summary, so we're going to go ahead and start with that one. But this one just explains, like, here's how your tax situation worked. At its most basic level, here's how your income was broken down. You can click into any section and it explains how that number is calculated. So for their income, they have some investment income. They have some Social Security, and they've got some capital gains and dividends. This case is someone that I would call they're in an artificially low bracket, right? They don't have any taxes that they have to pay, and that's a huge opportunity for us to strategically realize income before we have these massive RMDs coming up. So this tax explainer, super basic. It'll explain different terms, AGI, taxable income, how these things are calculated. We can see the brand new enhanced senior deduction as part of the big beautiful bill. And then our tax report, where I'm going to go next, this one's a little bit more detailed summary. So the tax report is usually about 10 pages long. We'll have our title and then key figures at the top showing total income, total tax. They're paying $0 in taxes right now, which some people might think is a good thing, but it's a missed opportunity in this case. I can see our marginal bracket, our average tax rate, the enhanced senior deduction that we're getting, and on the right side, I can see how our investment income is being treated. Whoops. I'm going to highlight that these reports do auto format a little bit. So if you click on the Manage Sections button, we are hiding and showing sections depending on what's actually on this tax return. So they don't have Schedule A, which would be itemizations. So taking the standard deduction, but we'll remove things from the report that aren't relevant to them. And mostly this is summary, but at the bottom, we've got these observations where it'll have ideas for tax planning opportunities. So if I scroll through this report, I can see our ordinary income, our capital gains, both at 0 right now. I can see where we land for Medicare, our Social Security taxation. Right now, up to 85% of our benefit is taxable, but because their income is so low, they actually have a pretty low taxable benefit, and that's being offset completely by the standard deduction and the enhanced senior deduction in this case. Investment income, Schedule B, Schedule D. I can see interest earning accounts. For our scenario today, we're saying they have 2 million in Roxanne's pre-tax account. They're going to have about 1.2 million in taxable assets, so brokerage, checking accounts, etc. And we'll give them about $800,000 in Roth assets under Robert's name. So I say that because that context isn't here on a tax return, right? On the tax return itself, we don't actually see the value of the accounts, but those values matter for how much we're seeing in taxable income every year. Tax efficiency of the investment income. This is a good place where we could talk about moving assets. Hey, you've got all this taxable interest. What if we moved that to make it more tax efficient, right? This is a long paragraph, but it basically says that for low income people, having taxable assets can be more advantageous. So right now they're paying 0%, right? So it's not a problem. But if their income was higher, if they're in higher brackets, that tax exempt status would look really good. Modified AGI. This is one of my favorite sections on this report. It does have all of the new Trump tax cuts from the big beautiful bill. So there's several different formulas for modified AGI. We're showing each definition. You can see where your income lands for that definition of modified AGI. And I can see if we're above or under the limit or within the phase out range for certain opportunities. So if our income is above or under, that changes if we qualify for that opportunity. And then phase out, we would partially qualify for the saver's credit. The eyeballs hide things in these reports. So if it's not relevant, let's say we don't have college age kids, then I might remove some of these things that aren't relevant from the report before printing or doing a presentation mode. Again, we only know what's on the tax return. We don't know like how old their children are. We don't know like all their other assets, right? So you can clean things up a little bit. And if I keep scrolling down, we'll see deductions and credits and observations. So the observations are probably the most valuable part of this report. It's running through a checklist of all the tax planning opportunities that we could identify based on this tax return. So there's a few hundred that we go through, and it's what you would call a deterministic model. So it's not coming up with new sentences. It's looking at the checklist and figuring out, does this opportunity make sense based on what's on that tax return? Some of it's just informational, like, hey, your Social Security was 48% taxable. You could have taken more cap gains at 0%. We could consider some Roth conversions. We could consider doing QCDs, and their income was also low enough to qualify for the ACA premium tax credit. They're both on Medicare in this case, but good to know. And then state tax hints too. If you put a state of residence, will show all of the state tax hints for that state. So the federal stuff is going to be personalized. These ones will not be personalized. It's going to show everything for a given state. So based on this return, some of our best opportunities, we could harvest more cap gains at 0%. We could think about Roth conversions. We could think about QCD if they're charitably inclined. So armed with that knowledge, I'm going to jump to the scenario analysis. We're going to start to analyze those opportunities. So if I scroll back to the top, you can jump straight to scenario analysis from here, but I'm going to go back just so that we can keep track of where we've been so far. So far we've looked at the tax explainer, we've looked at the tax report, and now we're probably going to spend the bulk of our time today in this scenario analysis section with some time reserved at the end to go through this multi-year Roth projection tool. So I'm going to go ahead and generate scenario. I'm going to ignore this pop-up for now. Tax law updates, great. So I'm in scenario analysis and I've got column 1 filled out in my scenario. That is pre-populated based on the tax return that I uploaded. So column 1 is just there automatically. If you click the green bars, that'll expand a section. So you can expand and collapse sections. You can jump to specific sections. It does have like all the detail from the personal federal tax return here. And then let me check the chat real quick just to double check. Oh, yep, there's some of our assumptions that we'll use for today. So column 1 is the return that I've uploaded. And then if I add a scenario, a lot of people will upload multiple years of history. So I could see 23, 24, 25. I only have 1 year in this case. So we're not going to upload other tax years, but I am going to copy from 2025. And we're going to ignore this pop-up for a second. I will come back to this. So I made a copy of 25. My copies I can edit. So I'm going to use this one to do a 2026 projection first. So if I change the tax year to 26, that gives me the updated laws with all of the brackets, inflation adjustments, the Trump tax cuts from the big beautiful bill that are slightly different. If I just change the tax year, all of that happens automatically. I'm going to click on the title and I can retitle this. I'm going to call this my base case projection for 2026. And then I'm going to scroll down a little bit so we can see more of the income section. The warning that I got with that pop-up, that's our way of flagging things that probably need to be updated. So the numbers are also in the chat, but we have a COLA adjustment for Social Security for 2026. We don't do that COLA adjustment automatically. We flag it with these warnings because we don't know if that's a partial year. We don't know if that's both people claiming Social Security or one person. For married filing joint, this is all reported on a single box. So a lot of times you'll see that where we have overrides because you copied information from another return and we don't have all the detail we need to make any assumptions. So if there's an override, you can go to that section. So I could go to the income section and I could go fix that thing. Or if you just click to view from that override pop-up, the overrides will be at the top. And to make the warning go away, you want to delete what's in that box completely. So even if you leave a 0, that'll be the new override. So you want to delete it completely. And then I've got my updated numbers for our 2026 Social Security with the 2.8% COLA applied. So for Robert, he's going to have 23,301. And for Roxanne, she's the breadwinner. She's 46,603. So that'll give me to my 2.8% COLA. I'm going to go ahead and close this box. And all my warnings are clear. Now I can see the delta between scenarios. So if you hover, I'll do that again. If you hover right in between these two columns, you can see this little delta triangle. And it'll show you everything that's different from one scenario to the next. So here's my base case. We have one small change, but we still are in the 0% tax rate, right? Even with that small change, that's not going to affect our income much at all. So the opportunity here is to realize income. We could realize capital gains. We could do a Roth conversion, right? And my next question is like, how much? How much could we do and still pay 0%? How much could we do and budget for the tax impact of doing that? So I'm going to go ahead and add another scenario. We're going to copy from our 2026 base case. And I'm going to start actually by modeling 2027, because I know for a fact that we're going to have an RMD in 2027. So I'm going to change this to 27. I'm going to change my title. And we're going to say with Roxanne's $2 million in her account, she's going to have about a $75,000 distribution, required minimum distribution in 2027. So I'm going to go ahead and click into this worksheet. And Roxanne's going to have $75,000 of a taxable distribution. For those following along with the math, that's 2 million divided by 26.5 gets us to about 75K for a taxable distribution. So now let's go ahead and like scroll down and we'll see where that puts us for tax rate for 2027. So if I scroll through, we can see some more details. And in 2027, there's how much we're going to have in federal taxes. There's the ordinary income bracket that we're going to be in. I can see our cap gains rate and our effective tax rate. So right now in 2026, we're paying 0. Beginning in 2027, we're going to pay at least a 12% effective rate. And those RMDs are only going to accelerate. So the account's going to grow. Every year, we're going to have to withdraw more. So if I can do Roth conversions and pay 12% or less, that's a no-brainer in this example. We may even want to be more aggressive than that, but if I can pay less than 12%, that's my logic for the minimum that we would want to do in 2026. So I'm going to copy again, add another scenario, and I'm going to copy from column 2, our 2026 base case. And in this one, we're going to do our Roth conversion analysis. So I'm going to call this 2026 Roth conversion and we're going to scroll back up to the income section. So if I scroll up to income or jump to income, under the income section, we have a row for a Roth conversion. And side note, a real Roth conversion would show up as a distribution on a real tax return, but we added this row just so that you could distinguish. It doesn't really exist. And if I type in any number there, I could type in a number and it'll tell me how expensive that conversion is, right? We calculate federal tax, we calculate state tax. So I could type in a random number, but I don't want to guess, so I'm going to use some of these optimization charts. There's two that are really useful. If you click the three dots and then you click solve for max, solve for max will tell me how far I could go before my tax rate increases for any reason. So right now we're paying $0 in taxes, so it'd be until we pay $1 in taxes. Solve for max tells me how much room I have before I fill a bracket, before I phase out of a credit or deduction. It solves for the first change. So to the next rate increase, in my example, if we add ordinary income, I can only add about $1,500 before we see a small amount of taxes, or I could add about $3,000 of capital gains before we see any change above zero to our tax rate. So that would be useful if I wanted to pay zero, but I don't want to pay 0% in taxes. I want to pay 12%. So we're going to use this next chart called the range calculator. What the range calculator does, it's going to open a new tab. It's going to give me a visual chart that shows me visually the incremental tax for every $1,000 that I add. So for Robert and Roxanne, if we're talking about ordinary income, my current taxable income of $26,000 would be zero on the range of our range calculator. So at 0, 0, we already have 26K in taxable income, and our tax rate is 0. If I add $1,000, this is a map showing every time you add $1,000, what rate is that $1,000 taxed at? So this 1,000 costs 22%, this 1,000 costs 30.2%, this 1,000 was relatively cheaper, it cost 12%. So it measures every 1,000 by itself, and I can see the ordinary income tax brackets in the blue. So it goes 10%, 12%, 22, 24. So that's the blue, is just the ordinary income brackets. I can see our Social Security taxation phasing in. So if we add ordinary income, we push our Social Security income above a taxable threshold where more and more of it becomes taxable. And that continues progressively until at some point we reach our maximum Social Security taxation. And then the next $1,000 of additional ordinary income can't create any additional Social Security taxation. We've already reached the maximum. So let's say I did like a 32K Roth conversion. We'd be taxed on everything to the left of that point. So that's actually kind of an expensive stopping point, because we would stop right after we maximized our Social Security taxation. So you want to stop after these valleys. Those valleys are the cheaper dollars, and then the high points are typically the more expensive dollars. So a really common mistake people make is they'll fill up a bracket and then not understand that it could trigger like all these other tax consequences. We could push our cap gains rate from 0 to 15%. We could partially phase out of this enhanced senior deduction. And then these dotted lines show the Medicare IRMA surcharges. So that would be the IRMA per year per person, 2026 income affecting our 2028 Medicare costs. So if we look at this chart, I don't want to pay $0 in taxes, so I could pick a couple other targets. Maybe we consider doing like a $45,000 Roth conversion. We could take advantage of this valley. Maybe we look at doing about 75K. We could fill the 12% bracket and see what that looks like. Or maybe we go up to this first Medicare IRMA cliff and we can see how far that gets us, about 115. And if I wanted to optimize around other points, I could pick other targets using this chart. And then I can come back and model. Here's if we do a Roth conversion of this amount, this amount, this amount. So I'm going to analyze 3 different Roth conversion amounts. Clicking on the pencil worksheet, we're going to do 45K first. As often as possible, yeah, try not to use the override boxes, use these breakouts underneath. So if I do 45K, I can see the effective rate for that conversion. So here's how much tax that Roth conversion would cost. And then the effective rate of the conversion is just the total tax divided by the amount that we're converting, gets a 17%. So we'll call this Roth conversion 45K. And then let's look at some of those other points that we optimized around. So if I copy and make a couple copies, so I've got 45K. Let's do 75 and 115 just for fun. So there's 75. And here we'll do 115. So now if I scroll down, once I've entered all these Roth conversion amounts, I can also see our total effective rate for each of those conversions. So when we converted 45K, we did create some taxes, but our overall effective rate was still pretty good. With 75K, we filled up the 12% bracket. So we just barely crossed into the 22% bracket. And that effective rate was really close to what our RMD is going to be next year anyways. And then I could see if we went all the way up to the Medicare IRMA threshold, we paid about 15% in total taxes for all of our income. So this is really useful to analyze for a single year, right? We could talk about how much of a budget we have for taxes. Also, it definitely depends on what the inheritors' tax rates would be. Robert and Roxanne in this scenario, they have again about 4 million in total assets. So they've got 2 million pre-tax, they've got 800K in Roth, they've got about 1.2 in taxable brokerage. Their living expenses are really low. They have artificially low income, right? They don't need the income. They're mostly trying to pass it on for legacy. Uh, so if we have opportunities to convert that legacy to post-tax, then it depends a lot on what the kids' tax rates are going to be, right? Um, if the kids are paying 12% in taxes, that changes our math a lot versus if the kids are in the 32% bracket. So it depends for Robert and Roxanne. It also depends on who's inheriting the assets. And in this case, this story, we're saying they don't need the money. They're just trying to pass on a legacy. And so this math could still make sense, right? This could still be a good deal, or we could even be more aggressive depending on the kids' situations. Before I jump to the long-term projection, I'm just going to show you how you would print some of these reports. So again, you can collapse and expand sections if you want to show more detail. You can show state taxes as well as federal if you're on the premium plan. So if I add in California, I can just do the California tax calculations, add scenario, and yeah, all the big beautiful bill stuff that's even state specific is accounted for. The way the state stuff works, by the way, is it mostly is waterfalling from the federal return. So it's going to pre-fill as much as is possible. Uh, there is a HSA deduction on the federal return, so it'll waterfall that information to the state return. California doesn't allow for an HSA deduction, which is a major bummer. Um, but we automatically account for that, right? Because we know the federal law, we know the state law. Holistiplan will automatically account for that in this waterfall. And if there are blank lines in this state section, that means like we don't have that detail from the federal return. So you could add additional details if you need to make other adjustments. But just with that waterfall, it'll get you like 95% of the way there. So you can calculate state tax as well as federal taxes. So if I wanted to print this report, I sidetracked myself. But if you wanted to print this report, you would go to this print section up here near the top. You can print up to 4 columns. So you do need to decide which 4 columns you want to show. I do usually like to show a delta comparison column. So if you have that delta open, you can print that as one of your columns. And yeah, it just pops a little bit better that way, where you can see that delta and kind of tell a story about the change that's happening. Awesome. I think I still have time to get to the Roth projection tool, so that's where we're headed next. I'm going to go back to the household, and we've already done the analysis for a single year. Now we're going to do like a lifetime analysis in this Roth projection tool. So going here to the Roth projection tool, thank you, Rachel. I saw she just punched all my assumptions into the chat. So I will go through those assumptions right now, and we're going to do a lifetime tax calculation. So if you click on Roth projection under the household, you go ahead and click create. I'm just going to call this like 2026 Roth conversion Roxanne. They are filing joint. I'm going to select both taxpayers, and then we're going to go ahead and create the Roth projection. I'm not checking this deduction blind box. I know that language is a little bit odd. That's just so that we can know if they get the additional deduction on their tax return. So I go ahead and create, and then we're going to click into this, and we're going to enter all of our inputs. There is a help video. You can tell I just created my account. There is a help video. I would click remind me later if you do want to see this, it's really good. But we're going to do like the speed run version of like how cool the Roth projection tool is. So in this left-hand panel, me personally, I prefer to look at the chart based on age rather than based on year. It just makes more sense in my head that way, but you can do whatever you like. And then I also like to show today's dollars versus inflated dollars. So I discount back to present value using a discount rate that's equivalent to my inflation rate. So my inflation assumption is 2%. We're not doing an itemized deduction. They're taking the standard deduction. They're married filing joint. And we'll go ahead and start punching in their asset information. So for taxable assets, we're giving them 1.2 million in taxable assets with a cost basis of 100K. And based on their dividends and capital gains and interest and whatnot that they were receiving on their tax return, we're determining for this example that 70% of their gains are attributed to growth. So that's unrealized capital gains. And then 2.4% of their 8% return is related to income. So that's the interest and dividends that they're receiving every year. For tax deferred assets, we're giving Robert none. We're saying that Roxanne is going to have an RMD problem with 2 million in pre-tax money. I am going to go ahead and adjust tax deferred assets. What this does is when you're comparing Roth assets to pre-tax assets, it is discounting the pre-tax assets by that amount. So it's saying my pre-tax assets have a 24% tax liability embedded in them. So as that $2 million grows, the tax liability also grows. That's just the default. And we're going to talk about more about this, but the Roth assets don't have that same problem, right? They're post-tax, but the pre-tax assets do have some sort of embedded tax liability. And for right now, we're just going to leave it at 24%. Roth assets, we're going to say they've got 800. And then we're going to start entering some of their income and expense information. I'm being a little bit less generous with their life expectancy than 100. We're going to go with 95. And I'm only going to enter Social Security income. The way the Social Security income works, you'll punch in a name for the Social Security income. So this is for Roberts. You can punch in an age or a year. So I'm using his current age of 74. And we're using the numbers from previous, but Robert is 23,301. We'll give it a 2% inflation amount. I'm going to apply and save. The way this will work is all of the stuff that you input will continue with that inflation rate unless you indicate that it stops for some reason. So if I wanted to say like he stopped getting Social Security at age 76, which doesn't happen for Social Security income, but if you wanted to indicate like changes in wages or pensions, annuities, whatever, you put inflection points into this. So you can be really specific and list out every year, or you can just continue a trend. For this, I'm just going to continue a trend. So yeah, or he gets Social Security this year and like every year ongoing. I'm gonna click out of this one and then we'll go do Roxanne. We're gonna say 95. She also gets Social Security beginning this year at age 72, and it is 46,603, inflating every year. Beautiful. So I've entered income, and then for expenses, they're living well below their means. We're gonna say that this is just their lifestyle expense, and you can go by age or a year, doesn't matter. Here I'm gonna go a year. Let's say they're only spending $60,000 every year. These are the people that you tell to go take a cruise and go spend their money. Excess cash flow is going to be reinvested, so it's going to accrue. And then for Medicare information, we are going to select that they're on Medicare uh, beginning this year, the current year. So we'll put their current ages for both. And their Part D annual premium, this is actually determined based on geography. So you actually have to look up the plan that someone has based on their geography, zip code specifically. But right now, I'm just going to use the national average of $600 for their Medicare Part D. And then I think we're done. We're going to do the Roth conversion next. So that's all the data input. And let's see, I'm going to scroll back up to the top and just change it back to age for a second. So looking at this chart, let's see, it's actually showing Robert's age because he's taxpayer 1. So Robert's age 74 right now, and he's taxpayer 1, so it's using his information. I could actually switch this and then it would make it Roxanne's information, which I might do. So let's make Roxanne client 1. So it shows her age. But, oh, did I do that right? Let's see, 2 million. Oh, it also switched their assets. I'm sorry if I'm losing some of you, but this does matter. So Roxanne has 2 million in pre-tax money. Make sure we're getting that right. Roxanne has 2 million in pre-tax money, tax deferred assets. And she is client 1. I specifically wanted to show that they have low income this year when she is age 72. And because of her RMD, their tax rate will be higher next year. So Roxanne's client 1, she has 2 million in pre-tax money. If we do some Roth conversions, right, I can see we have some room to fill up these brackets where we could consider filling up the 12, 22, 24% bracket and see the impact that has for the rest of their lives. Right now, if they don't do any conversions, eventually by age like 90, 92, 93, they're going to be touching the 32% bracket at some point. So the RMDs are going to accelerate, right? They're going to be in higher brackets later. And we also, since we're thinking about legacy, we should also consider the kids brackets, like what tax rate will the kids be forced to pay at some date in the future? And using that information, let's do like a 150K Roth conversion this year. That should get me close to the 24% bracket. And we're going to scroll down in the left-hand panel to do that. So if I go to Roxanne, we're gonna add a Roth conversion for Roxanne. We're gonna do a single Roth conversion of 150K. We're gonna say at age 73, we stop and don't do any additional Roth conversions past that point. So if it looks like this, we're doing a single Roth conversion in the single year, and then next year we stop. Now I can see that we're almost filling up that 24% bracket completely. So with our Roth case, we've got $202,718 in income. The 24% bracket was $211,400. And by doing that Roth conversion in a single year, it slightly changed our situation. We'll save about $40,000 in lifetime taxes from doing a single conversion in a single year. So here's our base case without the conversion. Here's our Roth case with that single conversion. So one conversion in 1 year. And the lifetime tax impact with all of our assumptions. I can see the impact on our Medicare over time. So we do trip that IRMA surcharge when we do the Roth conversion, but you can use this to show people it doesn't have a huge impact on their lifetime Medicare. Even if we did a really massive conversion, which we could do, I could show someone like this spike might be worth it if we can save in lifetime taxes. We can show portfolio value over time, the legacy accruing. The Roth case wins in our example because of the embedded tax liability that's still in our base case. You can see portfolio value difference over time. So this would show where our break-even point is, where the Roth assets end up coming out ahead. And then portfolio value by asset type. In our Roth case, we leave more of a Roth legacy. Again, I did a really small example to start. I'll do a more dramatic example with our final couple minutes. And then you can do RMDs over time. I will stick around for questions. I know we're coming up on our time. Last thing I wanted to show you is now that I've done all this work, if I go back to the household, and if we go to the Roth projection section, I just did all those inputs. I could copy that entire thing and we could look at what if we did like really aggressive Roth conversions. So let's say, we've got a $2 million balance. Like let's say we convert 300K every year and heck, make it 500K just to see what happens. So we're gonna convert it really aggressively for a few years and we'll stop when the money runs out, which should be by, age 76. So you can run variations of these and see the lifetime tax impact. I could evaluate the impact to legacy. A lot of people also use this to evaluate, like, what if someone had an early death? What if they both didn't make it to 95? What if Roxanne or Robert, what if they pass away early? You can see the lifetime tax impact. Like here's how much we would save in lifetime taxes if we did this really aggressive strategy. Look at the break-even points, look at all the charts. Once you've done the data input once, it's really easy to copy and make changes. So I'm gonna stop there. I think we ran up to the wire. Thanks everybody for following along. We will also be sharing this recording. I didn't see a lot of questions come through. Hopefully I'm not just missing them. But thanks everybody for the time. If you haven't already, reach out to our support team, reach out to us. We can also do individual sessions with you guys. So if you want to walk through like your own example, our team's happy to do that. You can connect with us at info@holistiplan.com, and we'll get you to the right resource. If you're a current user or if you're new to Holistiplan, we'd love to talk to you and walk you through it. Thanks, everybody.